The global financial markets witnessed a near-perfect storm last week.
After a global sell-off, European and Asian markets plummeting around the world. And we've been looking at futures, and they were more than 1,000 points down.
There are two things that do seem to be driving it. Friday's disappointment about how few jobs the US economy added in January, and Japan's decision to increase interest rates last week.
Nikkei, a leading index of Japanese stocks, closed the day down 12.4%. The TAIEX, weighted index on the Taiwanese Stock Exchange, was down 12%. Dow Jones Industrial Average futures fell by 444 points, down 1.1%. S&P 500 futures and Nasdaq futures also dipped 3% and 5.5% each.
Big tech, here we go. Look at them go down. Microsoft is down 20 bucks, that's 5%. Alphabet, 5%. Meta, 6%. Amazon, 6%. Apple, 9% down.
And what about the Indian markets? Well, they closed the day's trade in the red, but the losses were not too significant.
Sharp currency moves and renewed geopolitical tensions resulted in significant selling across global equities. In fact, the turmoil prompted the Bank of Japan, which is at the epicenter of the turbulence, to intervene and calm investors. The market appears to have stabilized for now, but the upheaval serves as a strong reminder of the potential damage unexpected events can inflict on this interconnected world of investments. In this episode, we try to make sense of the recent events and their implications. It's Friday, the 9th of August. I'm your host, Nishanth Vasudevan, the markets editor of the Economic Times, and this is the Morning Brief. Joining me in this discussion is Ritesh Jain, co-founder of Pinetree Macro. Ritesh's expertise lies in closely tracking major economic and geopolitical events worldwide and explaining their implications for investments in stocks, bonds, gold, crypto, and many more. Over the next few minutes, Ritesh will decode the events that shook the markets. Welcome to the Morning Brief, Ritesh.
Hi, Nishant.
Last week, the Bank of Japan unexpectedly raised interest rates, which resulted in the sharp rally in the yen against the dollar. Now, that triggered one of the biggest sell-offs in the global markets. Now, what has happened this week? The Bank of Japan has said that it will not increase interest rates whenever markets are unstable, which seems to have calmed down the markets for the moment. What is your assessment of the situation?
Nishant, we are used to spoon feeding by our central bankers. They telegraph all their actions in advance and they prepare us for those actions so that there is no undue volatility.
Right.
We are used to that path. Now, we all know yen is used for a carry trade. What is a carry trade? In simple terms, their interest rates are 0%. Your interest rates are, let's say, 7-8%. So you borrow in yen and invest in INR. Or if you have an INR loan, let's say any Indian corporate has an INR loan, they can go to the bank and say, I want to convert my INR loan into the yen loan. And overnight, they will save 6, 7, 8% on their interest rates, provided rupee yen remains stable. But then Bank of Japan comes out from nowhere and they did not prepare the market. They raised the rates by 25 basis points. They actually shock the market. And people look at Fed and say, okay, here is the most important central bank. No, Fed is not the most important central bank. The most important central bank in the world is Bank of Japan. And they told you that day. When the yen starts appreciating, you have to pay the margin. So secondly, if you are leveraged, the leverage has to unwind simply because you sell what you can, not what you have to. These are two different. So margin call plus leverage unwinding led to this massive fall across the markets. The biggest weight was taken by cryptos because they trade on weekends also. And weekend, what can you sell? Only cryptos you can sell. So there were some crypto wallets which were actually liquidated in a matter of 10, 15 minutes, the entire wallets. In a matter of couple of hours, $800 million of cryptos were liquidated. That happened over the weekend.
Oh.
Then obviously, if the yen is appreciating, it leads to deflation in Japan. And obviously, when the volatility spikes, bid offer spreads widen. But you have more sellers than buyers. So the impact on markets, impact on assets is much higher than what it should be in normal times. But then, as you said, they came in the morning and then say, guys, we've made a mistake. From next time onwards, if the markets are volatile, we will not do anything. And then the markets say, okay, markets have run over the central bank again. Central bank is now on back foot. Let's go ahead and start that carry trade again. So we went from 144 on yen to 147 on yen already in a matter of 12 hours.
Yeah, so Ritesh, it's very clearly the central bank versus the markets. So who do you think has won?
Again, markets have won.
Yeah.
Central bankers have again lost. And central bankers are again telling us, we have your back, guys. Go ahead and take that extra risk.
That brings us to the other big market, which is, of course, the US. Another reason for this entire sell-off was there were concerns about a big downturn or some kind of a recession in the US. Now, how real are those concerns? I mean, in your assessment, what are the economic indicators pointing to?
The economy is weakening, no doubt.
Yeah.
Their unemployment has gone from 3.6 to 4.3% now. No doubt about that. But the concerns were more exaggerated when the US bond yields, went down on Monday and Tuesday. Market always looks at fixed income to tell us, because market believes fixed income knows more than any other asset. If the bond yields are collapsing, it was like the world is saying, guys, the US is into recession.
So is US going into a recession?
Probably, in my view, till November election, it might not, because US Treasury Secretary has a lot of firepower in the form of $1 trillion of cash built up, which she can spend into the economy to prevent it from going into recession. And there is one more reason where US will not go into recession, at least for the next 3-4 months. The reason is market is getting worried that we might have Mr. Trump in White House again in December, January. Okay, there's a reasonable possibility, right?
Right.
And what is he saying? He's saying, I will put trade and tariff barrier against each and every country, right? Including China. So if I'm Walmart or I am Costco, what will I do? I will go ahead and buy more things from China now, so that tomorrow, if there is a trade and tariff barrier, I'm bypassing it.
Yeah.
Correct?
Yeah.
Any company will do it now, because we all buy from China. What is GDP? GDP is inventory building, and negative GD is inventory destocking. So it's reasonable to believe that inventory rebuilding will happen over the next 2-3 months. So we are in slowdown. Fed will take care of that thing by cutting the rates. Are we going into full blown recession? I believe I will reserve my judgment on that till the November elections.
Ritesh, so what does that mean for emerging market equities, and which also includes, obviously, it includes India?
Yes.
So let's say that they cut rates by 50 or 75 basis points in 2024 in the rest of the year. Does that mean that it's good time for Indian investors, Indian equities?
So even when the panic happened last week, between Friday and Tuesday, what happened was only US bond yields went down. US dollar index also went down instead of going up. If US dollar index went down and it is going to go down, it is good for emerging market equities.
Yeah.
Why?
Yeah.
Higher dollar index means lower liquidity. Lower dollar index means higher liquidity. So
Right.
if US bond yields are low at 4% US 2-year, dollar index does not get a bid. A little bit lower oil, which is good for energy consumer like India, and junk bond market, which is open for people to borrow money, which has again opened up today. Okay, means a lot of people are able to borrow in junk bonds. It's a good news for emerging markets if I look at all these 4 indicators.
Ritesh, another event that has caught the attention of markets was Warren Buffett selling off almost half of his stake in Apple. But what does it say about technology giants in particular? I mean, these have been the best performers, even if you look at not just the US, also from the global markets perspective.
So Warren Buffett said, I will invest in what I understand. He's been holding Apple for a long period of time. His selling of Apple very clearly states that he's not able to see that kind of future for a company like Apple, or to grow from this level to $3 trillion market cap to higher. He's not able to see that thing. And his increasing cash is a function of him not able to find good long-term opportunities. We are discussing emerging markets between now and November election. He doesn't invest based on 1 month, 2 months, and 3 months. He never buys things and sell it in one quarter. He holds it for years. So what he's saying at this point of time, with $270 billion of cash, what he's sitting on, he's not able to find sizable opportunities. Look, he cannot invest $1 billion. Okay, with that size, you have to invest a 10, 20, $30 billion position. He's saying, I'm not able to find it. And there's nothing wrong with it. There is a Warren Buffett indicator, market cap to GDP. US market cap to GDP is above 180%. And he says only market cap to GDP up to 100% is where he is comfortable. So according to him, US markets are massively overvalued. So I strongly believe that even if he were to look to buy assets, it will be outside US. So he has to wait for a crash. He has to wait for a crash which stays and the market stays lower for a long enough period of time for him to accumulate the way he did it after Lehman Brothers.
Does the same logic applies to the other tech giants also?
Look, there is no doubt money has been going over there. And the one which is exciting people is the AI bubble. Okay. I strongly believe AI bubble means they have to do a lot of capex. This was a concern raised in Google's con call, where the results were very good, but they continue to do capex. And when the analyst asked them, okay, where do we see the tangible benefits of AI? Google was not able to answer that question. So the jury is still out. Guys, we are going to spend a lot of money. Like Microsoft will be spending up $50 billion this quarter. We'll be spending a lot of money. Please don't ask us when we will get benefit out. So suddenly you have a question mark, which you can see with Nvidia down 30% from the top, Apple down 10, 15% from the top. Even all these tech giants, in my view now, will consolidate. Why? Because market says, guys, show us the money. You are investing, that's a good thing. Show us the money. The day you are able to show us the money, we will re-rate you again.
So every investor, if you look at it, they have been buying on dips. It has been quite a reliable strategy in equities. If you look at the past 3 years, there's so much happening in the world, in the economy, across markets. Do you think it is sensible to stick to that investment strategy or continue sticking to that investment strategy, the buy on dips one?
If Bank of Japan would not have relented and would not have bowed down to the market, I would have said then your cash can be an asset, because markets will become very volatile and you will get more opportunities like what happened over the weekend to invest in the market. But since they have also bowed down to the market, they will actually make it worse by allowing this bubble to become bigger. They are very explicit. Guys, we will not raise the rates when the markets are volatile. Actually, markets were not volatile when they raised the rates. Markets became volatile after they raised the rates. And now you have a Fed rate cut coming in September. Unless something blows out of proportion, something happens which is exogenous impact, just what we call about. Maybe, Iran closes Strait of Hormuz and oil goes up by $30. I'm not talking about that. I'm talking about in a normal scenario, buying the dip continues to be a good strategy till the time central bankers have our back and till the time the macros do not deteriorate beyond what we are seeing currently.
Ritesh, you have also been a strong believer in gold. How do you expect that asset class to play out?
I strongly believe that in the coming years, gold will be significantly higher. And I'll give you the reason for it. Gold is entering the system as a neutral reserve asset, which is not dependent upon whims and fancies of any central banker.
Correct.
And that is why even India is increasing its gold in the FX reserves. China is increasing, continuing to doing it every month. If India want to internationalize or have more trading partners outside of US,
Hmm.
then how will India do that trade with
Hmm.
anybody? Nobody will take INR. We are not such a big exporter.
Hmm.
But if we have more gold and we are able to
Hmm.
utilize that gold for giving comfort to our partners who export to us,
Hmm.
then it will be a great thing. China has already
Sure.
shown you they can do it.
Yeah.
And rest of the world is happily willing to accept gold. That's why if you see, more and more countries are repatriating their gold from London.
Hmm.
Even India just got it back, a smaller consignment back to India. Because
Right.
if you own gold in London, it is not your gold. You have to own gold in India.
Yeah. Right. If I were to ask you to put a number to in terms of returns, some kind of returns expectations from
Yes.
gold, what would be that number be?
2000 to 2023, the
Hmm.
annualized return of gold in USD terms was 9 to 10%.
Hmm.
That is when we were having a reasonably okay world. In today's world, where every country is indebted, the debt
Hmm.
to GDP is very high, including Japan, US, or rest of the G7. The only way to get out of reducing the debt is inflate away the debt.
Hmm.
That means have higher inflation. Between 2023 to 2008, 15 to 18% is a reasonable return expectation from gold over the next 5 years at least.
Yeah.
Unless US finds a way of reducing its debt through productivity.
Ritesh, before we wrap up this conversation, our listeners would want to know that, for any common normal investor, what
Hmm.
is the ideal portfolio allocation at this juncture? If we were to look at equities, bonds, gold, crypto, how should they spread it across at this juncture?
What I can say is that gold should be a part of your asset allocation. Fixed income needs to be a part of your asset allocation. And obviously, equity is for growth. In a
Yeah.
world where the only way you can get out of, overhang of debt, you need to be, unfortunately, your central bank and policymakers are pushing you to take
Hmm.
higher risk. Otherwise, you
Hmm.
will be a part of financial depression community where the value of your savings will come down.
With this, we wrap up our discussion. The key takeaway is that the markets have prevailed over central banks for now. This means that the risk-on sentiment in various asset classes, such as stocks, may continue. However, the recent events also present an opportunity to introspect and assess the health of your investment portfolios during these testing times. Thank you once again, Ritesh, for joining us for this conversation. And a big thanks to our listeners. This episode was produced by Vinay Joshi and the sound was designed by Amrit Reji. This is your host, Nishanth Vasudevan, signing off. Do like, share, and subscribe to The Morning Brief. A new episode drops every Tuesday, Thursday, and Friday on a listening platform of your choice. Keep listening and have a great weekend. All external news clips used in this episode belong to their respective owners. Credits are mentioned in the description.